Thanks, everyone, for joining us for this conversation around raising revenue to finance increased spending on economic security. I will be your moderator. My name is Catherine Rampell. I'm an op-ed columnist for the Washington Post, where I frequently write about economics and related fiscal issues. I'm delighted to introduce our panelists. Starting with Chye-Ching Huang, who is the executive director of the newly created Tax Law Center at New York University Law. Before starting the Tax Law Center, she was the senior director of economic policy for the Center on Budget and Policy Priorities, where she worked on the analysis and design of a wide range of federal, tax, fiscal, and economic policy proposals in collaboration with academics, practitioners, analysts, and advocates. We also have Joseph Leitmann-Santa Cruz, who is the CEO and executive director of Capital Area Asset Builders. Joseph leads efforts to create opportunities for low and moderate income individuals in the greater DC area to build financial security, savings, and wealth for the future. The organization also helps lead a citywide campaign to educate taxpayers about the Earned Income Tax Credit and other tax benefits that can boost their annual incomes. And then finally, we have Jason Fichtner, who is a senior lecturer and an associate director of the Master of International Economics and Finance program at Johns Hopkins. Prior to his work at Hopkins, he served in several positions at the Social Security Administration, including as deputy commissioner, chief economist, and associate commissioner for retirement policy. So all the bases covered today. He's also served as senior economist with the Joint Economic Committee of Congress. So today we are here to discuss potential changes to the U.S. tax system in terms of revenue impacts, administrative burden, and the compliance burden faced on tax filers, particularly lower income tax filers, and the secondary impacts of taxation. Over the years, there have been lots of different options outlined when it comes to ways to improve the tax code and the administration of the tax system. So it's a little bit hard to know where to start. Chye-Ching, I was hoping you could help us launch this conversation with an overview of the types of options federal policymakers have available to them for raising revenue, a sort of taxonomy of the tax system, if you will.
Thanks, Catherine. It's great to be here. And I sort of think about putting these options into 5 pairs of categories of ways to raise revenue. You can do more to collect the taxes that are already owed under law but don't get paid by certain people. And you can look at new revenue sources. You can look at measures that address the tax base, that is what gets taxed, as well as thinking about decisions about where to put the rates of tax on those things. You can pick taxes that are intended or motivated by trying to correct for some outcome that we don't like, whether it's carbon emissions or the level of inequality in the economy, some other type of thing that we're motivated by. And you can look at those that are thought of as more squarely revenue generators. You can look at measures that are really exclusively at the very top of the income and wealth distribution and those that are more broad-based. And you can look at incremental changes and more structural ones. And there's lots of overlap between those categories, and we often hear those categories pitted against each other. But each time I said "and," because it's my own personal view that there are great ideas in all of those buckets, and they're quite often actually complementary. And I think, as Jason will probably get to, when you think about just how far the US is from other developed economies in terms of how much revenue it raises as a share of the economy, and also perhaps not uncoincidentally how much it invests in things like early education, childcare, and other critical investments. There's a lot of room to move from here to where we might want to be, and therefore we're going to need to go into each of those buckets, I think.
So, Jason, this raises a question of whether we actually even need to increase tax revenue to pay for these kinds of income security programs that Chye-Ching was just talking about, the desire to expand. There are a lot of ongoing debates right now about whether deficits matter or how much they matter or when they matter. And I'm wondering if you could lay out for us your thinking on this question and how your view of the broader fiscal picture guides your thinking on what kinds of revenue raisers would be more or less desirable.
So thank you for having us here today. This is a great question and a great panel to have a discussion on tax policy. And I think it's important to realize first, to go to your question, deficits and debt still matter. And we've had pre-COVID historic low inflation and low unemployment, which shouldn't be happening with us spending so much money, and that sort of upending the traditional economic framework. But at some point, interest rates are going up. In fact, in the last few days, we've seen the 10-year bond interest rate go up, and interest rates have cost to them, to the federal government. For example, right now, according to the Congressional Budget Office, if we had just a 1/10 of a percentage point increase, so 10 basis points, annual increase over 10 years, so a full percentage point increase over 10 years, that would add $1 trillion to our interest costs. $1 trillion that we pay out annually in Social Security benefits. It's more than we pay out in defense spending. This is the opportunity cost of being able to do things like universal basic income, childcare, paid leave, et cetera. At some point, we have to pay it. I don't think we can just keep printing money over and over. Inflation will catch up to us and the dollar, the value will erode. So I think we should look at how do we pay for things. And certain things like infrastructure, we could probably borrow money for, but for things that are more consumption oriented, we should pay for them through tax revenue. And the question is, how do we do that? Do we do more targeted tax policy? Do we do more broad-based policy? Are we trying to focus on changing behavior or just raising revenue? And all those become a very important conversation, which we should get more into. I don't want to hog all the time, but I would caution that we have only so much capacity to tax. When you start thinking about comparisons between the US and Europe, for example, which has a higher level of tax revenue coming in, the United States is a little bit different. We do a lot of social welfare spending through the tax code, which they don't do. So Europe raises a lot of revenue and then spends it through social revenue or social welfare programs. We do a lot of ours through the earned income tax credit, the child tax credit. We're talking now about expanding child care credits. So a lot of our spending doesn't show up as spending in the outlays, but it shows up in the tax code. So we need to think about where we're spending money. Is that the most efficient way to do it? Do we want to stop doing that and just do direct spending programs, or do we want to keep using the tax code to divvy out benefits?
But why does that necessarily you make a good point that we do a lot of our spending through the tax side of the ledger. But why does that imply that there are lower limits to offsetting tax increases for us than there are for Europe, for example? I mean, presumably you could pay for the EITC through higher taxes on the higher earners, or through wealth taxes or something like that. I'm not sure I quite understand the framing here. Could you elaborate a little bit?
So one in European systems where a lot of people pay. So like you think about the broader base, a lot more people pay income taxes, a lot more pay the consumption taxes through the value added tax. So from a society standpoint, more people are paying into a system to get benefits. They see it as legitimate. In the US, we've created a system where actually half the people right now don't pay federal income taxes effectively because of refundable credits. They still do pay payroll taxes, they pay state and local, but from a federal income standpoint, we're relying more and more on a small group of people. For example, the top 10% of federal income tax returns right now are responsible for 70% of the federal income tax collected. And you might think, well, that's just the top 10%. Why does that matter? So I had to go check the IRS statistics recently. The top 10% starts as income at $145,000. And that can be for a married couple. So $72,000, per individual married, they're in the top 10%. So the capacity in some ways to keep taxing them on income, I think, is quite limited, especially if you start thinking about payroll taxes. But we might have more capacity if we start going to things like a value added tax or consumption taxes or carbon taxes.
Something more broad-based.
Yes.
Mm-hmm.
I think I would sort of add to that perspective by saying I think it is really actually quite important, as Jason said, to take a look at how we spend through the tax code. If you look at that spending through the tax code overall, though, and this is the bucket of things that we think about as tax breaks, sort of carve-outs from the usual tax rules. One of the biggest sources of those is tax breaks on income from capital. So income from businesses, income from holding on to assets that grow in value. And that does create potentially a lot of room to create sort of revenue generating capacity from addressing both the rates and the exclusions on that type of capital income. So again, when we sort of go back to some of these discussions, these different buckets that we raised before, I do think that ultimately, if we want to have a tax and transfer system that does as much to invest and does as much to reduce inequality as some of these European countries, we will ultimately need to get to some broader based changes. But given where we are now, there is plenty of opportunity to do progressive tax changes that are addressing some of those most regressive types of spending that goes through the tax code that are effectively tax breaks for people that have high incomes and wealth already.
Joseph, I'm wondering if you could help us think a little bit further about when we're discussing transformations of the overall tax system, how we should take into account low-income people's current experiences with it, and how much of a priority that should be when we are talking about major overhauls, designing policies around tax rates, or newly administered taxes, newly created taxes like a value-added tax or a carbon tax, or enforcement. How should the current experience that lower income people have when interfacing with the tax system inform our thinking about design?
Thank you, Catherine. And I strongly believe there's a lot of validity behind several of the key aspects that both Chye-Ching and Jason have brought up. But I would love to put three quick perspectives into our context here for the conversation. The first one is, as Jason was indicating, there are mechanisms within the current tax code that could empower somebody to maximize the tax code. But let's be honest with ourselves. The tax code in the United States is not set up and has never been set up for the benefit of those with low income, no income, or even moderate income. So we need to ensure that we know who is benefiting the most from the tax code. The second contextual point is that we need to realize that as a society, we're truly selfish and greedy when it comes to taxation, right? I spent more than 15 years harvesting losses proactively for the benefit of ultra high net worth families so we could significantly minimize short-term and long-term gains during my previous investment management experience. But one of the key components is that I strongly believe that we are being selfish and greedy to not enable low-income communities to be empowered through the tax code, not because it's an error within our society, but because we have not had so far bold visionaries as leaders who can really tell us the truth. If we're willing to provide the opportunity for all Americans to achieve their God-given potential, then we need access to resources. Nothing comes for free. So that real, frank conversation has still not taken place. And directly answering your question, Catherine, low-income community members are either fully not participating within the tax system through the tax code, or especially through the tax filing system, or are specifically being kept away. So let's focus on some of the community members who are being kept away. Undocumented taxpayers who are participating in the tax system but cannot legally benefit from tax credits. People who are currently incarcerated, survivors of domestic violence, people facing housing insecurity, homeless. So there are so many segments of our society who are completely away from even having the ability to truly participate in the tax system.
That would imply, getting back to some of the points that were made just now, that maybe the tax system isn't the best mechanism for reaching some of these populations, no? That maybe we should be administering more of these kinds of economic supports to some of the key populations you talked about through other means? Or do you think the solution is still through the tax code?
From my perspective, it's a combination of both. I do strongly believe that there are key components of the tax code that maximize the opportunity to save for specific asset purchases, whether it's retirement, savings for education, savings to buy a first-time home. But we do need to have that real conversation on what is taxation for, right? So it's not only a situation or conversation on revenue, but it's also on expenditures. And that is why we need to envision a better America where we are truly having the conversation of what is it that we want to aspire to be as a country and who are we willing to leave behind? Right now, 1 out of 10 Americans before the pandemic fell under the federal poverty line. That is completely something that we should not allow to exist. That is inexcusable in the wealthiest country in the world. Yet too many people are still falling through the cracks. And Catherine, it is not only a question, or it's not only a matter, right, of how much taxation is correct, but it's also a matter of why are we taxing corporations, individuals, and why we need to be focusing on specific social programs that do enable people to participate proactively. We all want for people to be launching micro enterprises. We all want for people to be buying homes. We all want for people to have the ability to work, because then all of us as society do benefit from that economic participation.
So, Chye-Ching, there are a lot of very ambitious proposals right now to expand economic security type programs, whether they're through the tax code or otherwise. And obviously, the premise of this panel is, how do you pay for all of that? What kind of revenue raisers are available? I'm wondering, when would we begin that process? We're in a recession, or at least in a weak recovery or weak economy at this point. Normally, one wouldn't talk about, or government would not be thinking about, potentially raising taxes on anyone during those kinds of economic circumstances, because of fears that it would be contractionary and it would further weaken a weak economy. So what's your thinking on timing here? How long do we have to wait before implementing any sorts of pay-fors for some of these programs? Do we have to wait? And does the experience of the so-called K-shaped recovery, the fact that higher income people have been relatively financially spared by the pandemic recession, does that influence how you think about this question?
I don't know whether I'm wearing my economist hat or my lawyer hat when I answer. It depends. I think it depends a little bit on what the spending is that you're financing, and also to what degree you're financing it and when. I think that the latest CBO projections, with still very low interest rates expected for a very long time, shows that even with the American Recovery Act, the $1.9 trillion package that's being considered now, the deficit to GDP ratio, and perhaps more importantly, the interest expense to GDP ratio, will take a step upwards from that one-time temporary cost, but the trajectory is not going to be steeper than it was prior to that. And in the long run, if you are making an investment like that helps get the economy back to a more robust GDP scenario, you are actually, if you're thinking about interest as a share of GDP being the target, you actually may end up doing it better than if you just let the economy sort of limp along and be at a trajectory that's far below its potential, and also take that potential downwards because you're doing so much harm to workers' productivity, to the potential for their children to grow up and do well in school and go on and have higher earnings. So I think those temporary one-off changes are a lot less problematic, and we shouldn't be worried about those. I think, however, we are going to start turning pretty quickly to some questions about permanent spending. There's a lot of investment needs that we need that are permanent, and filling the holes and some of those real inequities and lack of opportunities that we saw sort of laid bare by the recession. And I think even there, for things like what Jason pointed to, infrastructure, things that increase productivity over the long run, so improve the trajectory of the denominator, GDP, but also things that reduce the need over the long run for safety net spending, for other types of expenditures that you do need to outlay in order to sort of plug the gap when you put people on a trajectory that is over their lifetimes not as good as it could be. There are investments like in childcare or in the CTC or EITC that arguably meet that definition of investment spending, because it could both help the trajectory of productivity and also reduce some long-run fiscal costs. So I think that even for some of those permanent costs, there's a good argument you don't need to offset all of it. Again, taking Jason's point, though, there is a point at which you do start to worry about long-term interest ratios as a share of the economy. And once we get to that point, there are a lot of really, really good options that are not distortionary either in the short term or in the long term for raising revenues. So I think there's plenty of options there to meet those needs, and you could start with collecting taxes that are already owed under law, for which there's almost no sound economic argument that would hurt recovery or the long-term economy, and you can move your way down the list from there.
Jason, I'm wondering how you think about potential trade-offs when you're thinking through what the potential revenue raisers available are. How much should we be thinking about how efficient a tax is, for example, how little distortion it will cause in the economy versus how politically palatable it might be, or how much additional, what other social goals might be promoted by the revenue raiser, again, whether we're talking about a carbon tax or some other kind of corrective tax. How do you think about the various objectives, the ancillary objectives besides just the primary goal of raising revenue? That's the premise of this panel.
Thank you for that question, Catherine. I'm going to do my best to answer that succinctly and also go back to Joseph's, one of his main points, which I think we should pick up further in Chye-Ching's points. Economists are trained to think about opportunity costs. Everywhere we look, we see opportunity costs. And when we think about taxes, what's the opportunity cost of those tax dollars? What could be done with them? And one of the ideas when thinking about how to evaluate tax policy, as you mentioned, is efficiency. So think about efficiency, equity, and simplicity, right? So efficiency is how much are you minimizing deadweight loss? You don't want people changing their behavior unless that's the purpose. If your goal is to raise revenue, you don't want folks to try to avoid the tax, change their behavior, move to other lower tax items. You're trying to raise revenue. So just to give you a simple example, if you just did a 1% tax on sales, it probably wouldn't change people's behavior on what they bought. If you had 100% sales tax, it definitely would. The right, numbers between 0 and 100, where that it comes out is the efficiency and the behavior change. The other is equity. Again, we've talked about progressivity. How much do you want to tax high-income individuals, low-income individuals, or low-income individuals, high, medium, low? How much of the burden should they bear? 0, some, all? Those are questions we discuss in a context of politics. And that's where we get to a big debate, right? Equity is one of the things that we're going to argue. I think we all would agree on what looks like a simple tax, an efficient tax. But what's fair is going to be open to a lot of subjectivity. And these are the trade-offs we have to talk about. And Joseph got to a really good point, which I think is lost in the larger tax debate, is what is the role of our tax system? Because we talk about taxes and transfers. If you want to have a system that raises revenue, and the IRS is good at raising revenue, they're not good at basically giving money away. That's not their job. Their job's to collect it. You could design a tax system that raises revenue efficiently and target it to whom you want to raise it from for various activities, and then have a better transfer system. So, for example, to an economist, there should be no difference, and I use the word should, be no difference between getting an earned income tax credit as a check from the IRS or having Health and Human Services or Department of Labor or some government agency give you a check. But they have different political connotations. The reason we're doing so much now for the tax code is that Democrats and liberals and progressives get to have government intervention in helping people with welfare support, and Republicans get to claim they're giving you a tax cut. So both sides like it, and that's why our system has been designed that way. We're sort of path dependent, and there's a lot of inefficiencies, whether it's on how we support housing through the home mortgage interest deduction, state and local tax deduction. A variety of things should be changed. And we should have a discussion that Joseph's pointed out. What is the role of our tax system? What should the role of the transfer system be? And where's the most efficient way to do the revenue collection and the benefit distribution that is targeted, that is equitable, and has the least distortionary effects on the economy?
And Catherine, if I may, just on something Jason was mentioning, I have a simple mind. I'm not as intelligent as everybody else in this panel, but within our family, my wife and I have the honor of having 2 amazing kids. And we have similar conversations within our family structure, right? We have limited resources and we have aspirations, we have objectives, we have goals. And what's most important for my wife and myself is the well-being of our kids now and into their future. So we limit specific expenses now for the current generation so that the next one can have a better shot at stability and prosperity. I strongly believe that it's not that the American people are not intelligent enough to have this conversation. It's that we're still, unfortunately, lacking leaders who are willing to have a frank conversation as to the same conversations that all families throughout the nation have. How are we going to spend what we're able to generate? How are we going to spend what we are able to borrow so we can meet the specific objectives of our family? And that's a basic conversation that I do not see happening and have not seen happening for decades in America. And that is where we need bold leaders to really say, let's keep it simple, folks. Let's really find out what is it that we as Americans want to accomplish. Who are we willing to leave behind? Hopefully nobody. And how is it that the tax system and the social safety nets can be more improved? It's not that difficult, but we need to be honest with one another as to what we're willing to give up. If I were to be asked, am I willing to have my sales taxes be increased by 1% or a carbon tax be established because if I drive my kids around to their soccer practice, but as long as I'm being told what that money will be used for, I am fully in favor of that. And that type of information, that type of frank, honest conversation is not happening throughout the country.
Jason, this brings up a question that you and I had discussed, or that the group of us had discussed prior to this panel, which is it desirable to have a dedicated funding mechanism for some of these programs? Like if you're going to have a value-added tax, should that money be raised to go and plugged into basically the just go into the general treasury fund, or is it more advantageous either politically or fiscally for some, economically for some reason to have that as a dedicated funding stream for some particular social program or objective? What's your thinking on that general question?
I'm going to quote Chye-Ching on this and say it depends. And I do think in some ways there are areas where I do not think having direct dedicated revenue source is worthwhile or reasonable. For example, for funding national defense, there are things that go to literally the common good, in which it's hard to say what's my benefit from national defense. I don't know what my dollar benefit is, and so those things that are national benefits come out of general revenue. But for things in which we have an earned benefit in some ways or a tied benefit, Social Security is a good example, is considered an earned benefit and is politically popular because people say they pay into it, they deserve their benefit, it has support, and we can monitor the program based on revenues going in, outlays coming out, and try to figure out where we're short and who needs to make up the difference, how it should be made up, et cetera. We could do various things like that when it comes to unemployment insurance compensation, which has dedicated revenue sources. But if you're trying to spend a lot of money and you don't necessarily want to be tied down to one source of revenue, you could have it come out of general revenue and just have various sources coming in, but we don't have that revenue right now. And so you think about what could raise a lot of revenue. A value-added tax could. A value-added tax, I think it was Larry Summers who made the joke that Democrats will learn to love a value-added tax and they realize it can help the poor. Go back to all the social welfare programs that support. And Republicans will learn to love it and they realize it's a tax on the poor. And so we need to think about where you want the revenue going and where it should come from. I think for various social programs, not like food stamps, for example, I'm backing them out of general revenues, but for things that are looking at like income support programs, they should have some sort of dedicated revenue source. I think that makes it more politically popular. And I think it also makes it more fiscally, in some ways, responsible. And
I think we have time for maybe one more question before we get to general Q&A from the audience. Chye-Ching, one proposed way to make various kinds of social programs, including social programs administered through the tax code, more accessible to the poor has been to make them more universal. The idea of reducing or even eliminating means testing as a way to reduce the administrative burden determining eligibility. There's a big debate going on right now, I think, about this question, particularly among Democrats, but not exclusively among Democrats. There's a discussion right now about a child allowance, expanding the child tax credit, and in a way that would be both more generous, but also potentially more universal, which is, particularly under the construction that has been proposed by Mitt Romney. Could you talk a little bit about the advantages or disadvantages of making these kinds of programs more universal and what greater universality implies for the necessary funding mechanisms? Can you just claw back, for example, the benefits from rich people at the back end if you give them a child tax credit, a monthly child allowance, for example, or any of these other kinds of income security programs that could be designed to be more universal up front and then, in theory, funded by more progressive taxation on the back end? That's
a great question. And I'd love to sort of pick up on one aspect of it that relates to something that Joseph was mentioning before. And that's the sort of the simplicity and the how people experience and access the program. And with means testing at such high levels as is being proposed for the child tax credit, that's not going to be the source of complexity or reduced participation for low and moderate income people. You're looking at phase outs in these proposals that are sort of at the top 2% of income earners. And it's really going to affect very few people whatsoever. There's a lot, however, of other delivery questions that have yet to be fully grappled with that are really important for how people can access and participate. One of the other ones that I don't think is important that much is whether it's the IRS or the SSA that's actually doing the delivery. In fact, IRS delivery does have some benefits. If you look at the participation in the EITC and CTC, despite all of the barriers that Joseph pointed to, which are things that Congress chose and that Congress can address, the participation in those programs is actually quite a lot higher than what you see in other programs that require, for example, going to the what you would traditionally call the welfare office, or filling in forms before you get access, programs like SNAP, for instance. So there are some actual potential benefits, and you can choose to make things accessible and easy for people, whether it's run through the IRS or the HHS. The biggest problem is making sure that you get the types of things that Joseph flagged, who you make it eligible for it, what sorts of paperwork you require them to do before they can actually access the credit, whether it's clear to them that if they get things wrong for an error or because their family circumstances change, that they're not going to be faced with an unexpected tax bill. All of those things, to my mind, are much more important than phase outs or who delivers the actual benefit when it comes to ensuring robust participation.
And what about the funding mechanism? Does the funding mechanism need to change if a benefit is more universal?
Well, if you're going to try to, I think as you flagged, in theory, you can achieve neutral tax transfer system. You can achieve the same result by doing it either of the two ways. I think it's ultimately often a question of what the political limit is on actually explicitly raising revenues as opposed to phasing out benefits like this. And for those, I think it's a question by question, it's a provision by provision, and sometimes even package by package discussion about whether or not you can, the size of things that show up on the spending side and the tax side.
Mm-hmm. Well, I think now we're going to move to some audience Q&A.